Good morning, traders and investors. Roger Scott here, Wednesday, April 5th, still the senior strategist of Wealth Press. It's about 7:53 in the morning. The market's going to gear up to open up in about an hour and 37 minutes to be specific with you. I believe it. Yeah, hour and 37 minutes. I still have my math skills. So as I told you guys yesterday, I was expecting the market to start selling off. Now, just to give you an idea, I'm not looking for a massive sell-off. Not yet, at least. One of the things that's surprising me, actually, is the bond market. I got up charts for everything except the bond market. The bond market actually rallied, and it's still rallying, and it's now near the 107.60 level. Now, as you guys know, I am planning on shorting it if it gets to the 110 level. But one of the reasons why the bond market is breaking out to the upside is because the economic data that's coming out of Wall Street isn't all that great. The fundamental data I'm talking about. So you could see here, we're in kind of a channel. Now, I'm very cautious, and I don't want to sell this thing till it gets a little higher. But if it gets just a hair higher, if we see a little more upside, maybe 2 more basis points, I'm selling this sucker because I think bonds are still going to go down and interest rates are still going to go higher. Now, there's a lot of sectors right now, and I'll go through this in a minute. There's a lot of sectors that are breaking down to the downside, and as you can see here, the market's opening up a little weaker. Now, this is very random. This doesn't mean we're going to be down for the day. And this is just very much randomness. Anything below negative 100 on the Dow, probably 120 with the volatility now, or up 120 is random. So if you see 60 up, 60 down, 80 up, 80 down, that's random. Back about 5, 6, 7 years ago, that might have meant something. But with this volatility, it's just randomness. Now, I want to make sure you guys understand something important. So I want to show you something before we get into momentum levels. Now, what we were looking at yesterday and what I made my basis on the fact that the stock market's coming off was the 20-day moving average. Remember, the 20-day moving average, it's a very short-term indicator. It's a very active, not a day trading, but I would say short-term swing trading indicator, where the 50-day is more substantive. So just because we're seeing consumer discretionary at 89%, we only have 45 above the 50-day moving average. Now, the fact that we're at 45 is actually worse because if you have so many trading above the 20-day, but you don't have at least 50% trading above the 50-day, that's a big problem. So some of them are trading at 89, but consumer discretionary only has 45% trading above the 50-day, whereas consumer staples has 95, but 68 trading above. So even though it's 95, this has more strength because this has 68% trading above the 50-day, and this is more of a foundational than the 20-day. So again, you have to kind of look at them together. So in my opinion, the ones that are really struggling right now are the ones where, like, for example, where Infotech, you got 82, but you got 61. So it looks like it's coming off. But again, you got to look at them together. You can't look at them at one by one. Like healthcare, you have 89, but you've got 60 above. So that's a little more stability. Also, in terms of seasonality, what we've been seeing the last couple of days is a big up move on Monday, which we saw, and then a down move going into the rest of the week and then coming up towards the end of the week. So I'm not looking for a major crash or anything like that. Just to be clear, I'm simply looking for momentum levels to decline and the market to cool off a bit after what we've been seeing, especially with the bond market rising, which means interest rates are decreasing, which means there's a less chance that the Fed is going to take action. Again, we still have plenty of time till the decision is made, but that's the case. As far as data today, you've got ADP report, that's coming out in about 17 minutes. International trades and goods and services, that's coming out at 8:30. And a lot of folks send me an email asking me, Roger, why is the energy market, why didn't it continue moving higher based on what happened the last couple of days with OPEC cutting production? It kind of went up and then it just kind of sagged. Well, the fun isn't over yet. That's number one. You have sustainable upside, and it could fill the gap and go higher. But more importantly, it's because there's an increased fear of a recession. Remember, energies do really well in an inflationary environment. They don't do good in a recessionary environment. And if the economic news is getting worse, which kind of surprises me that the bond market's going higher, because as the news is getting worse, I guess investors are thinking that the Fed is not going to change rates, which is probably likely, but that increases the risk of a recession, which is one of the reasons why energies have not been going up. Also, if you look at the number of stocks and energies trading above the 20-day line, it's a little overbought. Matter of fact, notice where we're at right now, just to kind of give you an idea. Look at a 3-year chart on energy. Look at a 5-year chart on energy. Look at a 9-month chart on energy. We're getting up there. So in the short term, we may see something like this. We may see something like that. But look at that. When you see, look at the last year, look at the last 2 years. When you see us get to 100%, what happens typically? It starts cooling off. There's just too many stocks in the energy sector going to the upside right now. And if the data comes out weaker today and it shows further evidence of not inflation but of a recession, it'll impact energy. So today may not be another strong day. We may have a little more weakness coming in. But I wanted to show you that. Now, let's talk about the economy, and then I'll get into the nitty-gritty and show you the other momentum levels on the other sectors. So 3 major U.S. benchmark indices finished the regular session lower as a swath, what a word, of weak U.S. economic data heightened worries that the Federal Reserve rate hiking campaign might trigger a deep recession. Oh my God, what a shock. We've never heard that before. They didn't say they were going to continue raising rates, did they? How dare they? I'm being sarcastic. This is pretty much well known. The only one that's being squirrely is Mr. Squirrely himself, Powell. Tuesday trading session, economic sensitive industrial stocks were the biggest drag on the market, with the sector's bellwether Caterpillar plunging 5%. Glad I wasn't in Caterpillar yesterday. Financials also weighted on the broader market, pressured by drop in bank stocks after Mr. Wet Blanket Jamie Dimon warned in a letter to shareholders that the U.S. banking crisis is not over yet and its impact will be felt for years to come. Energy stocks retreated, giving up some of Monday's gains as investors' attention shifted to the impact of slowing economic growth on crude oil demand due to potential us being in a recession. Data on Tuesday, U.S. job openings report. This is one of the reasons why I think the bond market started moving higher, because worse data on employment means less chance that the Fed will raise rates, which means bonds moving higher, especially the long-term bonds. 1 3/4-year low, weaker than expectation of 10.4 million, pointing to a cooling off in the resilient labor market. The labor market has been very, very strong. I'll be very interested to see what the ADP report says today. But if job openings are going to be cooling off, if employment's going to start cooling off, then the Fed is going to have one less chip to play, because one of the things they've been saying, they can go harder on interest rate hikes because the labor market is tight. Well, if the labor market starts cooling off, then they don't have that chip to play. U.S. factory orders also fell for a second straight month. Now, factory orders is very interesting because that has a lot to do with China, and China hasn't been doing all that great. Now, we got some clarity from the Fed yesterday. Loretta Mester, she's pretty straight up. She said that policymakers, and remember, she's not being so political because she's not the head like Mr. Squirrely, should move their benchmark rate above 5% as inflation remains too high and stubborn. I think they're going to go to about 5.4, 5.6. That's what I think. Meanwhile, futures are now pricing in a 56% chance of no hike and a 43% chance of a 25 basis point rate hike. Now, either yesterday or the day before, this number was 60-something% and this number was 40-something%. You see how it's moving? And that's why bonds are moving, because the weaker the data, the less chance or the less chips the Fed will have to play in terms of raising rates. So they got to be calm. They got to be really calm and careful and watch the market. Today, we're going to be focusing on non-manufacturing PMI. We're looking at the PMI to be at 54.5 compared to previous of 55.1. Also, the non-farm ADP employment data, I can't wait to see that. That's coming out in like 15, 20 minutes. And they're looking at about 200,000. Will be very interesting to see. And then Friday, tomorrow we have jobless claims, which is going to be right at about 200,000. You'll see Bullard speaking. We'll see if he echoes what Mester said. And you have the employment situation, which is going to be the biggest report. But Friday markets, I believe markets are closed, or it's a half day. I'm not so sure. I don't think markets are open on Friday. I'll have to double check. But still, tomorrow we have jobless claims and James Bullard speaking. Now, momentum levels. Infotech, look at where we were yesterday. I told you, I hate to say I told you so, but I did. And now we're cooling off. Now, again, it doesn't mean we have to go all the way down to the base. It doesn't mean that. We can cool off a little bit, come back up. But whenever you start seeing 100% of stocks hitting the 20-day moving average, that means the market or that sector is just a little overbought and needs a breather. And the last time we were at these levels was right here. I mean, look at that. It just starts coming off, starts coming off, starts coming off. There's just not much upside potential. And the option premiums in the call get really expensive because you have 100% of the stocks in the sector trading higher above the 20-day line. That means they're trending up. And remember, markets are mean reverting, which means whatever comes up has to come down. This is a yo-yo market, okay? Infotech is not the only sector that's doing that. Look at consumer discretionary. Consumer discretionary, I didn't even show you this yesterday. I was afraid. The last time consumer discretionary was at this level was 820. It was August of 2020. We haven't got to this level. So when you see consumer discretionary, you see Infotech doing the same thing. They're very related. And remember when we were looking at our sectors, I showed you how they have to come back together. Well, how about telecommunication services, right? That's Google's in the communication services. There's a lot of tech stocks here. Look at these levels. This is January 2022. We didn't even go to this high before. Look at that. We didn't even go to these levels. Look at this. This is craziness. It just doesn't seem sustainable. Now, again, you could have what happened here where we go down for a few days and come back up. But right now, with the holiday approaching, with fear of a recession, I don't know. I would be really, really cautious when you're at these levels. I mean, the picture speaks for itself, right? I mean, it really does. Now, consumer staples are doing the same thing. They've been on a big run up. Consumer staples, I actually think, are going to kind of pull one of these. I think they're going to continue staying here. But again, when we're up here, you got to be careful. Now, again, it doesn't mean every stock is going to go down, but you got to be cautious. I mean, look, you always will have some stocks that will stay firm or strong no matter what. Utilities, look at utilities. I mean, look at what happens. It's like every time, it's like a computer. You see it going to 100, it sells off. 100 sells off. It hit 100 yesterday. That means 100% we're trading above the 100-day, above the 20-day moving average, and it's coming down right now as well. You think that's it? How about energies? Look at that. So a lot of sectors, not every sector, but a lot of sectors are doing this, and this is not very positive for the economy. And interest rates going higher, again, they're not going up for the right reasons. I mean, bonds going up, they're not going up because interest rates are going to go lower voluntarily. They're going up because the economy is fearful that the Fed is going to put us into a recession. So very, very, very important distinction to understand. Now, as far as individual sectors, just to kind of give you a picture of where we stand, you still have technology and communication services and now consumer discretionary being the strongest three. Now, I am pretty confident that these will cool off and you'll start seeing some of these come up. But overall, we're a little too strong. And remember, interest rates and technology, recession, technology, they don't go together. It's like water and vinegar. They don't mix very, very well. So you got to be really, really cautious right now. Now, looking at them visually, technology looks like it can have another down day, maybe a few more down days. Now, again, remember what I said. This is a 20-day moving average. This is not a long-term indicator. This is a short-term indicator. Again, communication services appear to be kind of weaning. They don't seem to be wanting to go up very strong. Consumer discretionary already folded 2 days in a row. Consumer staples needs a break. And look at this. Look at the run-up. I mean, look at this run-up. It went from 72 to 75. This thing went from 135 to 150. This thing went from 51 to 58. This sucker went from 133 to 150. They need to cool off, and that's what I'm saying. We need a little cool off. We need a little breather. Industrial's definitely cooling off. Look at that. That's the caterpillar. Material is definitely cooling off. Energies is cooling off, and it may continue cooling off if the economic data is weaker than expected today. Healthcare looks like it's coming off. Financials looks like it's coming off, especially with Jamie Dimon. Utilities, they still look like they want to party a little bit. And real estate looks like it's going to be kind of choppy for a while because that sector is overdone to the downside. Matter of fact, if you look at real estate, let's take a look at real estate and see where it is right now. Real estate, I haven't even looked at it yet. Yeah, it still looks like it's got more to go. See? Real estate looks like it's got more to go. Let's see here. Or it may, it could bottom out with everything else. Basic materials looks like it's got a little more to go. Industrial, let's look at industrial. I like these 20-day moves. Industrial looks like it's already halfway down. So again, if interest rates keep going down, but if we're not going to get into a recession, then tech, consumer discretionary is just taking a little breather. But if the odds of a recession in the labor market keep getting worse, then the Fed is going to start talking. We're going to take action. We're going to take action. And then there's not going to be a negative correlation or a positive correlation between bonds and tech. You're going to start seeing a negative correlation. And overall, honestly, I mean, why go long right now when you're in a position where when it looks like this, it's probably best to cool off for a few days or maybe a few weeks till we get our bearings. Now, today is Wednesday, and on Wednesday I give you so in other words, summary here is be really, really careful and watch your butt, because the next few days, remember it's a fragmented week. I think Friday's off and Monday's off. We have Easter holidays. Don't get into trouble. Stay out of trouble. Now, as far as stocks that I'm really liking right now, let me tell you what I'm liking right now. A lot. Let me show you this. Let me go to my modified scanner. All right. Let me give you some idea of stocks that Uncle Roger likes here. And by the way, folks, make sure to like this channel, subscribe to this channel, and post comments and feedback. I respond to them. I do. I'm definitely going to be picking up some GE if it goes down a little more. I think the pullback is great. I wouldn't even think twice about buying GE right now. It's been just an amazingly strong stock. NVIDIA is really strong. Now remember, not every stock is going to go down, or every stock is going to go down a lot. But the stocks that I'm liking right now, I like GE. I like Wind still. I like First Solar. But if I had a pick of any stock right now, let me show you what it would be. It wouldn't be Alta Beauty. It would be Quanta. I like the natural gas stock, and I think energy still have some more upside. I would probably be snapping this up because it's a utility energy kind of a play, and it's been outperforming everything. So power or GE, those two stocks have been really good to us. You don't need to pick 1,000 different stocks when you're trading. Just find a couple of good ones. So GE or power, I would like, and I would probably go about 3 months out and buy one strike out of the money option. Now for the downside, oh boy, we got a lot of fun stuff to the downside. VFC, as I told you yesterday, I hate this stock. I think the stock is going to go down. Hate is a strong word, but I'm not a happy camper with the stock right now. Also, Newell Brands looks really, really weak. So, and Fidelity National Information Services. Honestly, if I was you, I would short Fidelity National Information Services. Has been a nasty stock. And let's see here. Hasbro, the toy maker. Toys right now, we're not approaching the holidays right now. So definitely toy manufacturer, Hasbro, I would sell. And I would put probably a buy stop at the 55 level. I'm not a big stop loss guy, and then, where was the other one? Fidelity National Information Services. Don't like this stock, and I think the stock is going to go back down to the base 49. Let's see how my favorite stock is doing. I'm joking around. Nah, they're at the lows. I was hoping it would pick up a little bit so we can get it, but it just keeps going down. I've been telling folks to sell this stock now since probably a long time. Now, folks, before I let you go, remember something important. In the past 2 weeks, $400 billion has been injected into the economy. And because of this move, a rare buy signal is flashing on one group of market-leading stocks. That's right. That's why I'm going live at 1 p.m. tomorrow for a special presentation. I'm going to reveal how to potentially capitalize on these explosive returns we could see after interest rates peak out. Click the link below. Check it out. If you're in the YouTube Wealth Press channel, it's below the video. If you're on our website, then you see a big link, probably in red or blue or green. But follow along and make sure, join our Telegram channel. I give free trades there sometimes. I show pictures of my cat, Clyde. Oh, yeah, it's like that. And go to the YouTube Wealth Press channel, like, subscribe, and post comments below this video so I can respond to you face to face, person to person. I respond personally to those. Have a great, great day. Watch out. We're still in a period of instability right now. The data from the Fed, which is coming out in about 2 minutes and another 30 minutes, can change things. But be very, very cautious. We're in a slippery slope right now, and I think today we may have another down day. Be careful out there. Remember, it's a short week. A lot of things can happen. A lot of traders are off. Liquidity's a little wonky. markets are wonky. Bonds are going up because of fear of a recession. Be careful out there. Follow the link below. Check out my class tomorrow. It's going to be really, really cool. I'm going to show you how I went like 11 trades, 10 out of 11 winners in a row in the last 10 trades. And you'll love it. You're going to love it. Follow the link. Check it out. Have a great day. Send me emails. support@marketgeeks.com. Bye.